If you're concerned about the prospect of a substantial decline in stocks, yet would still like to be invested in stocks, then this video is for you. In this video, I will walk you through a hedged income stock strategy that provides 59.9% of downside protection against losses over a 22-month investment horizon, while still maintaining total return potential of 37.4%. My name is Ron Didesco, and I am a CFA Charterholder, which stands for Chartered Financial Analyst. I am a hedged income financial advisor with Bespoke TFC Capital. Let's take a look at this hedged income investment strategy. This example is for shares of Bloom Energy, which provides clean energy solutions. Over the past year, shares of the stock have rocketed from $16 a share to $302 before pulling back to the current level of $250 a share. All you need to know for now is that because the stock has been so volatile over the past year, the hedged income investment strategy that I'm about to walk you through provides a risk-return trade-off that is exceptionally compelling. Very quickly, with shares of the stock at $250, what does Wall Street think the stock should be trading at? Well, there's a surprisingly broad range, with the low target being $217 a share and the high target being $310 a share. In between, we have $254, $235, $285, $279, $235, $295, $267, and $255 a share. So keep in mind that Wall Street analysts on average think that the stock at $250 a share is pretty close to fair value with some downside exposure and some relatively modest upside potential. Instead of just buying shares and hoping for the best, this strategy is called selling a cash secured put. This is a strategy that we implement on behalf of clients for customized diversified portfolios. With the stock at $250, at implementation, the strategy consists of not owning any shares. Instead, what happens is you hold cash in your investment brokerage account in a quantity that is sufficient to potentially buy shares of the stock in the future if shares of the stock are trading below a specific price. This is how the strategy functions. So, at implementation, with the stock at $250, you do not own any shares. Instead, your brokerage account holds cash, and we on your behalf go into the options market, in this case expiring in 22 months, and we would sell a put option at a strike price. What does that mean? A put option provides the buyer with the right to put shares to you, meaning force you to buy the shares at a particular price, the strike price, on or before a certain date in the future called the option expiration date. In this example, the strike price is $160 a share. What this means is that with shares of the stock trading at $250, you do not own any shares today at the time of implementation, but you hold enough cash such that if shares of the stock fall below the strike price of $160 a share at any point over the next 2 months, then the owner of this option, the put option, can force you to buy the shares at $160. Why would you enter into this contractual obligation? Because in exchange for doing so, you receive income called hedged income of $54 a share. This is your guaranteed income to keep so long as you maintain this position until hedge expiration in 22 months. How is this strategy implemented? Well, it's actually really easy. Put options, just like stocks, actually trade on exchanges. Let's take a look. So with shares of Bloom Energy, ticker BE, currently trading just below $250 a share, the strategy consists of not buying shares and going into the options market, which in this case is out to March 17th, 2028, which is 22 months into the future. The strategy consists of holding cash in the brokerage account sufficient for a potential purchase of shares and selling a put option at a strike price or a potential contractual purchase price of $160 a share. The current bid is $52.50 and the ask is $55.95, meaning that the price that the transaction would settle at would be approximately $54 a share. Let's take a look at the math for selling the cash secured put. The first step of the strategy is do not own the stock at the current price, which is $250 a share. The second step is to then sell one put option expiring in 22 months at the strike price, which is $160 a share. This strike price is the contractual purchase price if the stock falls below the level on or before the option expiration date or the hedge expiration date in 22 months. In exchange for selling this put option, hedged income is received from selling the put of $54 a share. The cash that needs to be held for a potential share purchase is $160 a share. This is simply equal to the strike price of $160. What this means is that the hedged income received of $54 divided by the cash held, or the at-risk investment for this investment structure of $160, translates to income, or hedged income, of 33.8%. Additionally, as a benefit to the strategy, while holding the cash generates interest. We conservatively assume that over the 22-month investment horizon, that the interest income on the cash held will equal 2% annually. 2% annually over 22 months equals 3.7% of interest on cash for this investment horizon. That equals $5.87 against the cash held of $160. So what this means is that the maximum profit for the strategy, if the stock does not fall below the strike price by option expiration, the strike price being $160 and the option expiration date being in 22 months, the maximum profit is $59.87 a share against a cash investment basis of $160. This equals $59.87 divided by 160, maximum strategy profit of 37.4%. What happens on the downside if the stock falls? Well, on the downside break even means that the stock would have to fall below $100.13 by hedge expiration in 22 months in order for the strategy to lose money. How do we achieve that number? That number is simply the strike price of $160 a share less the maximum profit, which is the hedged income and the interest on cash received of $59.87. So the strike price of $160 less $59.87 equals $100.13. $100 a share divided by where the stock is currently trading at $250 means the stock would have to fall more than 59.9% in order for the strategy to lose money by hedge expiration in 22 months. Because we're selling this put option at a strike price below where the stock is currently trading, this means that the stock can fall to as much as $160 from $250, and the strategy profit is still maximized or optimized. So the degree the stock can decline and the maximum profit, or the hedged return, is still maximized is 36%. The stock can fall as much as 36% over the next 22 months, and the strategy profit of 37.4% would still be maximized or achieved. Let's take a look at the visual representation to better conceptualize what the strategy looks like. So the strategy is selling the cash secured put. The hedged income received is 33.8%. The expected interest on the cash held, the interest income, is 3.7%. So the total return potential is the sum of the two, which translates to 37.4% on a rounded basis. The strategy also provides that downside protection of 59.9%, meaning the stock would have to fall more than 59.9% by hedge expiration 22 months in order to lose money. The degree in which the stock can fall and the strategy profit is still maximized is that 36%. That's the downside threshold maximum profit level. Let's take a look at scenario analysis to see what might potentially occur where the stock could be trading at come hedge expiration in 22 months. So the stock currently trades at $250 a share, and at hedge expiration, if the share price is $250, the stock return will be 0%. However, this strategy return, the hedged return, would be 37.4%. In the event that the stock rises further, say up 36% to $340, then the hedged return still outperforms at 37.4%. If the stock continues to rise, say to $370, which is 48% higher than here, then the hedged return will underperform at 37.4%. This is the inherent limitation of the strategy, that irrespective of how much higher the stock may be at by hedge expiration, in this case 22 months, the maximum return potential is capped at a specific level, which in this case is 37.4%. Now the benefit is that if the stock rises modestly or is unchanged, then instead of a say a 0% return if the stock is unchanged, the profit would be 37.4%. An additional benefit is that the stock could even fall to a specific amount, and instead of losing money, this strategy generates the maximum profit. As an example, if the stock has fallen 32% to $170 by hedge expiration in 22 months, then the hedged return is 37.4%. It is still maximized. If the stock continues to fall, then there still are profits down to a certain degree, which decline. So the profits decline to a specific degree. Let's take a look. So if the stock has fallen 40% to $150, the hedged return is still 31.2%. If the stock falls 48% to $130, the strategy delivers a profit of 18.7%. And if the stock falls 56% to $110, the strategy still delivers a profit, which is 6.2%. In the event that the stock falls further, say down 59.9% to $100, then the return for this strategy is zero. It's break even. Below $100 a share is where loss exposure begins. While the strategy seems really compelling, keep in mind that this does not constitute investment advice. All of our client portfolios are customized with diversification in portfolio weights and strategies that are tailored for each client. This strategy today may be appropriate for some individuals and actually not appropriate for others for a multitude of reasons. Another variable to give consideration to is that when investing with a cash secured put, the strategy is only available in increments of 100 shares. That's because one put option is equal to 100 shares. So it's important to customize portfolios with appropriate strategies and also with appropriate portfolio weights, knowing that put options, or these put contracts, only exist in increments of 100 shares. You cannot implement for 1 share, 7 shares, 13 shares like you can with individual stocks. If you'd like to learn more about hedged income investing, then like and subscribe to this channel, and also leave a comment to let me know what your thoughts are. If you would like to learn more, feel free to go to our website, which is at BespokeTFC.com. If you would like to see different portfolio examples for dollar amounts ranging between $300,000 and $6 million with 3 different strategies, then in the top right-hand corner, click Insights. Alternatively, you can go to BespokeTFC.com/insights. Thanks for watching, like and subscribe, and leave a comment.